And this is a question about intrinsic value. You write and speak a great deal about intrinsic value, and you indicate that you try to give shareholders the tools in the annual report so they can come to their own determination. What rules or principles or standards do you use in applying those tools?
We could see in looking at any business what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second. That would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate, the strengths and weaknesses of the company, and how that would look over a 10 or 20 or 30-year period.
These videos that Warren Buffett and Charlie Munger put out are extremely educational, and I really want to convey a lot of the messages that both Charlie Munger and Warren Buffett say, especially in this video.
Attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out, not by selling it to somebody else, because that's just a game of who beats who, but in a sense, by what the asset itself produces. That's true if you're buying a farm. It's true if you're buying a business. And the filters you described, there are a number of filters which say to us, we don't know what that business is going to be worth in 10 or 20 years, and we can't even make an educated guess. Obviously, we don't think we know to 3 decimal places or 2 decimal places or anything like that, precisely what's going to be produced. But we have a high degree of confidence that we're in the ballpark with certain kinds of businesses. The filters are designed to make sure we're in those kinds of businesses. We basically use long-term, risk-free, that's government bond type interest rates to think back in terms of what we should discount at. That's what the game of investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by what the asset itself will produce. If you're an investor, you're looking at what the asset is going to do, in our case, businesses. If you're a speculator, you're primarily focusing on what the price of the object is going to do, independent of the business, and that's not our game. So we figure if we're right about the business, we're going to make a lot of money, and if we're wrong about the business, we don't have any hopes. We don't expect to make money. And in looking at Berkshire, we try to tell you as much as possible as we can about our business, of the key factors. Those are the things that Charlie and the things we put in our report about those businesses are the things that we look at ourselves. So if Charlie had nothing to do with Berkshire, but he looked at our report, he would probably, in my view, he would come to pretty much the same idea of intrinsic value that he would come to from being around it, for X number of years. The information should be there. We give you the information that if the positions were reversed, we would want to get from you. And in companies like Coca-Cola or Gillette or Disney or those kind of businesses, you will see the information in the reports. You have to have some understanding of what they're doing, but you have that in your everyday activities. You'll get that kind of knowledge. You won't get it, in terms of some high-tech company, but you'll get it with those kind of companies. And then you sit down and you try to print out the future.
I would argue that one filter that's useful in investing is the simple idea of opportunity cost. If you have one opportunity that you already have available in large quantity, and you like it better than 98% of the other things you see, well, you can just screen out the other 98% because you already know something better. So that people who have a lot of opportunities tend to make better investments than people that don't have a lot of opportunities, and people who have very good opportunities, and using a concept of opportunity cost, they can make better decisions about what to buy. With this attitude, you get a concentrated portfolio, which we don't mind. That practice of ours, which is so simple, is not widely copied. I do not know why. Now, it's copied among the Berkshire shareholders. I mean, all of you people have learned it. But it's not the standard in investment management, even at great universities and other intellectual institutions. Very interesting question. If we're right, why are so many eminent places so wrong?
Warren Buffett and Charlie Munger talk about something that's extremely important in the stock market, which is intrinsic value. What is intrinsic value? Intrinsic value is a measure of what an asset is worth. This measure is arrived at by means of objective calculation or complex financial model. Intrinsic value is different from that current market price of an asset. However, comparing it to the current price can give investors an idea of whether the asset is undervalued or overvalued. Financial analysis uses cash flow to determine the intrinsic or underlying value of a company or stock. In options, pricing intrinsic value is the difference between the strike price of the option and the current market price of the underlying asset. So, key takeaways, right? Number one, there are various ways to calculate intrinsic or true value. Number two, discounted cash flow analysis is used for many intrinsic value calculations. 3. Intrinsic value is a core concept that value investors use to uncover hidden investment opportunities. 4. In options, trading intrinsic value is the difference between current price of an asset and the strike price of an option. And number 5, when an asset's market price is below its intrinsic value, it may be a smart investment. What I absolutely love about Warren Buffett's content is that he gives a take that was relevant 100 years ago, it's relevant right now, and it's going to be relevant 100 years from now as well. And that is exactly why you should subscribe to this channel, is because we provide so much amazing content just like this, talking about the stock market, finance, and all of that. And we try to make every single video that will be relevant 100 years from now as it is relevant right now today. Thanks so much once again for checking out this video of income views. Remember to subscribe. If you can't subscribe, I cannot continue making videos just like this one for you. Also remember to click the like button and also comment as to what you think of this video and what else you would like to see in terms of personal finance, Warren Buffett content, and so much more, because we cover it all on this channel. Thank you so much for watching, everybody, and I will see you in the next video.